Now back to your money, your wealth.
Talking to Larry Swedroe, got him on the line. High-frequency trading, and then now it's looking at the efficiencies of markets. Is it fact? Is it fiction? I mean, are markets efficient? Is there mispricings? What should investors do?
Well, it's a great question, and I think the right way to look at it is the way Gene Fama, who's considered the father of the efficient market hypothesis, he's the one who first coined the phrase. In his own first paper on the subject, here's what he said. Efficiency, like all perfect competition, supply and demand economics, is an ideal which real-world markets can only approach. Empirical work can find only how close to or how far from the ideal it is. In other words, the efficient market hypothesis is really only a model. It provides a framework for us how to think about how markets work. It's not meant to be a perfect depiction of how markets actually work. And what we do know from academic research, there are lots of anomalies that cannot be explained if the market were perfectly efficient. For example, we know that small growth stocks, they have had very poor risk-adjusted returns. In fact, because they're small, you would think they would have, and therefore more risky, they would have higher returns than large growth stocks. And in fact, they have far underperformed large growth stocks, and they have far underperformed the market as well. IPOs have had very poor returns. Stocks in bankruptcy, let's see, what else? And penny stocks have had very poor returns. And the biggest challenge to the efficient markets is the fact that momentum stocks have provided better than market returns. So stocks that have done well in the last year continue to do relatively better for another 4 to 5 months on average, and stocks that have done relatively poorly for the last year continue to do relatively poorly for another 4 to 5 months, which cannot be explained by any rational theory about how markets work. So we have all these anomalies, and that means that clearly the market is not perfectly efficient. But what really matters is, can people exploit the inefficiencies after the expenses of the effort? And there are several ways to think about that. The first is we look at the S&P annual report. They call it the SPIVA report card, active versus passive funds. And every year, without question, they show the same thing. As sure as the sun rising in the east, they report that active managers underperform in virtually every asset class. The vast majority fail. So that's one test.